Good morning, ladies and gentlemen. Uh, I think I would like to start off with a slightly unscheduled comment before the presentation. I'm deeply impressed by what PMS Bazaar team is doing here. The book was quite unexpected, So I've seen the rise of PMS Bazaar over the years. This is the second session in Dubai. Makes me feel immensely proud that somebody has managed to straddle and take care of this whole diverse space of alternates in this country. They are the beachhead in terms of that. My suggestion to you, Pallav, for next year is that you should now move into the world of podcasts. Okay? You've got a lot of video content, you've got a lot of events happening. I think podcast is the next logical step. And I look forward to hearing a lot more people coming onto your podcast channel now and talk about it. So, my congratulations to you and your entire team for this wonderful experience. Talking about experiences, I'm very well aware of the fact that I am presenting in front of an eclectic audience. Some of the finest minds from India and the UAE are here. And it will be my attempt to just throw a little bit more of insight in terms of what we call the PERMATAGA concept. Now, what's PERMATAGA? As human beings, we all gravitate towards predictability. We have our favorite food, our favorite film star, our favorite conference, our favorite book. And whenever things move to the contrary, we revert to the mean. We try to come back to what is predictable, what is comfortable. But as we go along, and I'll show you some data points, beyond our predictable, our comfort zone, there is a lot of change happening out there. We are sometimes aware, sometimes not aware of how much change is happening. But for a fact, what is permanent is change. We see visible change around us across macroeconomic, just give me a second, yeah. There are a lot of changes around us across macroeconomic environments, business cycle, people movements, consumer behavior, product preferences. We sometimes don't realize. In the book, which Thomas Friedman has written, and I would urge you to all read that book, it's called Thank You for Being Late. There's a very profound statement he makes. He makes a statement that the three factors which have always impacted human history are all happening at the same time today, which is change, rate of change, and global warming. He argues the fact that rate of change today is so fast that human beings are unable to adapt to change. By the time you have, when the Industrial Revolution happened and horses were replaced by cars, there was a fair amount of time given for human beings to adapt to this change. But now the velocity of change has increased so much that by the time you have guidelines coming in for Uber, you already have driverless cars. And you're seeing governments struggle across the world trying to cope with change. Ultimately, we're all human beings. So change is the only constant. And just to highlight a few points, if you stick to what you're comfortable with, this is what has happened just over the last 2 generations. United Kingdom, believe it or not, at one point of time was the numero uno in global trade. They had the largest stock exchange before they were displaced by the NYSE post-World War I. Germany and US led global trade for such a long time that even today, mentally, we are conditioned to thinking that these are the countries which straddle trade across the globe. Having said that, from 1990, China has been nibbling away to such an extent that today, Germany and US contribute to half of what China contributes to the world trade. You're talking about China. China was the chosen one. And look, in the span of the last 10 years, people are moving from China as the chosen one to China plus one. They're already seeking alternatives to China. It's just happening right in front of our eyes, this entire change which is happening. And if I have to just double click and get into a stock, GE Capital was, at one point of time with 93 billion in the 1990s was the number one stock. They grew dramatically over the next 20, 30 years. The market cap increased by 70%, but their ranking today is 87th. Which shows that how fast the ecosystem has grown. And if you would have stuck to GE as a bet, you would have made money, but not as much money as the rest of the world. Moving from stocks to themes, you'll see that every 10 years, there's a new investment theme. Change is constantly happening around us. In the 1950s, it was Europe and European stocks. In the 1960s, the original Nifty 50, the US Nifty 50, led by consumerism, manufacturing, actually drew the index to the roof. 1970s, you had the oil shock which happened, and you had barrel of oil jumping dramatically. So you had emerging markets and commodities for the next 10 years. 1980s, who can forget 1980? That was when Japan came out from nowhere. And by the end of 1980, the markets peaked out. So much so that it took 40 years, 50 years for them to just come back to the levels they were at that point of time. In the 1990s, all of us who were in the job market saw the dot-com boom, saw the rise of NASDAQ. It was a complete sea change for people who were always thinking of manufacturing and manufacturing-led industries to see the rise and rise of tech. And it was like no tomorrow. I mean, I don't know how many of you remember in 1999, when we were all waiting for the clock to turn to 2080, everybody was worried that planes will fall out of the sky, computers will shut down just because the clock would change from 1999 to 2000. And guess what? It didn't happen. But that led to the emergence of the tech industry in India. You're talking about 2000, the BRICS formation happened. The term BRICS was coined, and everybody suddenly started looking at emerging markets not just as fragmented entities, but as a consolidated entity. BRICS commodities ruled the roost from 2000 to 2010. Come back again to 2010. US came back with a bang, but it was highly concentrated in terms of a few stocks, which are popularly known as the FANG stocks. We are now into the decade of 2020. Who knows what we see when we look back? Permanent state of change. This is a very interesting slide. I thought I'll just share with you. We are all worried about the markets cracking and the markets bouncing back. It's amazing. And these are some historical events which have happened, which have impacted market cycles. What was the event? How many days did it take? So what is the percentage from the peak, the sell-off? How many days did the sell-off take place? And how many days did it take to recover? You'll find a very dramatic insight here. If the market fall is more than 15%, I confess this is limited data, but this is very useful data. If the market fall is more than 15%, you will find that the number of days to recover can be dramatically high. But if it is less than 15%, it recovers in no time. The events can be different, the constituents can be different, but what looks like is that every time the market is tanked more than 15%, it has taken unprecedented time to bounce back. And we can talk about the global financial crisis, we can talk about COVID, we can talk about a lot of things. Traditionally we've always believed that there is a cyclical relationship or non-cyclical relationship, the way we want to look at it, between equity and bonds. They move in diverse directions. Well, you know what? It doesn't really happen during times of crisis. They tend to converge to the mean. Both bonds and equity, and this is basically the rolling correlation of S&P 500 versus the US 10-year interest rate swap. Every time there is a crisis, the correlation somehow seems to disappear. So that's something which is very, very useful to know, that it is not as predictable, that they move in opposite directions. Volatility has been constant globally. There is no single country. So if you're basically looking at a country and you're saying that this is a country I want to be invested in, it's a sobering thought for some of us who think that India is the center of the universe, that no single country has ever given consistent returns. You need to have geographical diversification, which has sadly been lacking till about recently. So you look at the US, you look at the UK, you look at Germany, they've actually moved in tandem most of the time. So people think that you can have a correlation or a negative correlation, but they moved in tandem. You look at what is happening in terms of India. In India, you're talking about returns from different market caps, and these are reflected by the indices. Interestingly, they all tend to converge. When the market rallies or when the Nifty rallies, all indices rally. But what was a little bit surprising, actually not so surprising, is small caps have actually done much better than what we give them credit for. These are calendar year returns, and of course, a lot of you might want to slice and dice and argue with me on that, but these are index returns and this is a fact. Okay, let's look at how customer preferences are changing. I talked about change being permanent. How are customers adapting? How many of you actually remember that in 99, 2000, we actually had dial-up connections, right? And I still remember a comment, the last time I was at DAIS, Pallav had mentioned in his opening statement that the way India is growing, at the airport in Dubai, they give you a SIM card with 1 GB free data, right? 1 GB free data is nothing in this country. We consume 1 GB data probably in half a day. At the cost of data. So it's just amazing how things have changed, how customers have adapted, how behaviors have changed. Now let's look at retail investors shifting away from traditional investments. I still remember how fixed deposits used to rule the roost. And 30 years ago, when I was making a presentation like this, mutual funds were considered to be alternates. And look at how things have changed. Managed investments have done much better and are now actually growing much faster than fixed return products. More household money is flowing into capital markets. You are seeing that it is going at a very rapid CAGR. These are SIP numbers, and this is just the beginning. By the way, why I mentioned SIP numbers is because even a few years ago, if you would have talked to somebody about SIP, he would have said mutual funds, no, I don't want to invest. Now, apparently SIP is a separate word in the lexicon of an investor. Let's look at how cash has been treated. We've traditionally been very comfortable with cash and using cash, and this is particularly about India. UPI has now dethroned cash as king. If you are an Indian and you're in India, I don't need to explain this to you, but if you have not been to India, and I think now UAE also has UPI here, I think it was launched, the RuPay card with the J1 card, you will start understanding how UPI revolutionizes everything, okay? Cash has already been dethroned, and I think more and more people will keep less and less of cash. More and more customers are opting for digital payments. There was a time when people did not want to transact online. Now, not only are they transacting online, not only are they buying online, they're actually investing online. A lot of retail investment has started coming in direct through mutual fund sites, which speaks about the customer's comfort with change. This is a very interesting slide. None of us can actually debate the fact that credit is a very, very important part of our ecosystem. It is believed that close to 50% of the country's GDP's growth will be fueled by credit, and close to $50 billion worth of opportunities will come in the next few years. But look at how the landscape has changed. From FY 2002 to 2024 and then on to 2032. Most of the growth initially was being funded by NBFCs till 2018, and mutual funds were also lending to NBFCs. But now what is happening is there's a serious regulatory arbitrage, and AIFs have stepped in. Alternate investment funds have stepped in. This is one of the fastest categories of growth in the private credit segment in the AIF business. So we talked about change being permanent. Let us talk about what is the impact of change. In this permanent state of change, there are good alternatives. If you haven't guessed already, alternatives is a pun on the word alternate investment fund. And I'm here to demonstrate to you in the next few slides how alternatives can not just adapt themselves to changing requirements, they're already settling in terms of the investment landscape. Let's go to this slide where, we are talking about basically alternatives currently are with the savvy segment, with the aware segment. I may or may not classify them as HNI or ultra HNI because sometimes HNIs and ultra HNIs need not necessarily be savvy and the other way around. But the fact of the matter is today you can actually access so much more across the ecosystem through AIFs. Let's talk about venture capital. You can participate in social causes which ultimately do well for the society, but they don't affect your rate of return. You still manage to get very high returns. You're talking about private equity. More than going to the market, before going to the market, a lot of promoters are now able to raise money at competitive rates. And then when you go to the market, you're actually incubated, ready, and able to justify your valuations most of the time. Private credit, I just mentioned to you. I think India's hunger growth for private credit is going to be unprecedented. And we're already seeing a lot of players step up and take advantage of that. The big advantage in private credit, unlike credit in all other mechanisms, is here the investor is willing to stay the course. 5 years, 6 years. He's not looking at immediate liquidity. And he gets compensated for that by slightly higher returns. Real estate. I've had a lot of discussions on real estate in the last few days that I've been here. But look at how people are accessing real estate. You really don't need to buy a property. You can actually access it through real estate debt funds, a variety of, and I'll just showcase to you what are the other alternatives you can use to access real estate through the AIF platform. Long only typically has been something which has been the domain of managed accounts. But if you have a situation wherein you need a concentrated portfolio, you need a thematic portfolio, you need a high risk portfolio, you need a curated and customized portfolio, well, AIFs are there for you. One thing which AIFs can do, which most others may not be able to do, is to launch a long short fund, a hedge fund, an absolute return fund. Going long is something we all naturally gravitate towards. Going short is something AIFs can do for you. Now, if you look at alternatives, you will probably get into a situation where you're asked, why alternatives? Why are people gravitating towards alternatives? This was a survey done by Preqin, and turns out that the top two requirements of any investor in this segment is basically diversification, and the second one is low correlation to public markets. We all can access public markets. So we need to have a lower correlation to public markets. And if you look at how things are moving from private equity, which again talks about high absolute returns, but diversification. You're talking about hedge funds, again diversification, but low correlation to public markets. To private credit, which is diversification and again low correlation to public markets. So I think willy-nilly it is satisfying the basic needs of any investor in this particular category. And that is why you see this growth. I talked to you about how you can access various slivers of the market, of the industry, of the economy through AIFs. This is just to give you an idea. If you're talking about, so this is basically a survey of around 511 funds. The percentages reflect the number of funds in each category. So if you look at the equity or neo equity segment, which is angel fund, venture capital fund, and private equity, you will find that close to 50% of the money comes in from there, and it can come across from accelerator funds, social venture funds, pre-IPO funds, early stage funds, and the like. You look at private credit, again there are two parts to this, which is performing credit and real estate debt. And if you look at private credit, it's such an interesting space at this point of time. You have venture debt, which was a category which was virtually non-existent 4 or 5 years ago. This is to promoters who don't want to liquidate their equity at this point of time, but want to grow. So they borrow which is called venture debt. Mezzanine bonds, performing credit, something which we also do very well. Special situations and real estate debt, again, which we do very well. I'll explain to you at the end of it. Real estate funds, look at the type of real estate funds. Distressed assets, special situations, affordable housing, commercial, warehousing. Where else can you access this range, except for AIFs? Long only I just talked about, but just look at long short. I mentioned a few. One of the key strategies worldwide, which alternate investment funds have been successfully doing, is absolute return funds, multi-strategy funds, market neutral, and believe it or not, there are debt funds in the category 3 segment. So this is a change which is already happening. This is an alternative which is already there, catering to basic investor needs. Let's look at very quickly, and I think this is something I will just devote maximum 10 seconds on, because I'm sure most of us are familiar about this. Look at the number of registrations which have happened and the number of total commitments at this point of time. The total number of commitments has increased dramatically across Cat 1, Cat 2, Cat 3. I was just told that as of December 2023, the AIF industry has touched the magical number of 10 lakh crores across Cat 1, Cat 2, Cat 3. For an industry which is barely 10, 12 years, this is a very, very significant achievement. Not just that, you will also find on the right-hand side that the deployment of money. So traditionally, AIFs have always been talked about as you raise money, but you don't deploy money. You raise money, you get a lot of commitments, but you don't deploy it fast enough. As the economy is growing, you are finding that the deployments are jumping dramatically across all segments of AIFs. 89%, 93%, almost 100% of the money raised of the commitments raised is drawn down and is also deployed. So what do you want to do today? Are you going to participate in this growth as a spectator, as a participant, or as an orchestrator? You could do it all three ways. You can see, you can act, or you can create. Most of us who are into more predictable mindsets, would tend to be spectators, would tend to be very cynical about what is happening. I still know of some people who sold at the bottom of COVID, and they've still not come back into the markets thinking that the markets will fall further. That's your comfort zone. You go back there, you say, I would wait for my time coming in and all of that. But for all of us, there are alternatives. There is an avenue to either be a participant or an orchestrator. Let me explain. You can actually be a participant or an orchestrator by what we call as the ROSE framework. Okay, what is the ROSE framework? First of all, robust risk management. What seems to be too good to be true at times might just be. So you have to be very careful, very mindful. You have to make sure that you manage risks. This is more of an orchestrator to ensure investor protection, currency fluctuation in this part of the world. This is very important. Geographical bias and individual decision making. Optimal risk adjusted returns. From returns to risk adjusted returns, we've seen the journey. Now you have to marry it with the investor's risk appetite and make it optimal risk adjusted returns. And with alternatives, you can actually do that. I'll share that with you. Seamless experience. I just heard Pallav talk about onboarding, of NRIs through his platform. Investors will always invest where they're comfortable, not necessarily convinced. And one of the things which gets them comfortable is a seamless experience. Where you get a seamless experience, you can rest assured that things are moving very smoothly. And last but not the least, emphasis on quality across equity and fixed income segments. Let's talk about robust risk management. Two-factor authentication is something we all know. I think the most effective strategy for minimizing risk is what AIFs do is they will give you an asset class diversification. In the same AIF, you can get different asset classes, or they will give you different asset classes specializing in that. The other is geographical diversification. An AIF can actually give you geographical diversification. That's what we call as two-factor, authentication or two-factor diversification, two-factor risk management. If you look at the moving parts in terms of managing risk, typically the core is basically how you look at risk from your perspective. Risk can mean different things to different people. So there could be currency risk, there could be credit risk, there could be liquidity risk, there could be valuation risk, there could be operational risk. More often than not, and I'm saying this with all utmost seriousness, one of the biggest risks is the person himself. Too often I've seen when I go and talk to people and talk to them about their portfolio, especially equity portfolio, I've been told very nicely at times that the amount of time I've spent in capital markets, people have seen much more than that. And वो हिंदी में कहावत है कि बंद घड़ी भी दिन में 2 बार सही time दिखाती है. So don't try to teach me something, And this is a human risk. This is a human bias. And that is something which gets curated over a period of time. But what we can identify are these risks. And what is the corrective action framework? Look at description of features, very clearly define what risk means to you. Let's not just bally about it in terms which we can't go granular on. Then there has to be a qualitative and quantitative approach. You have to measure it quite regularly. You have to report and you have to escalate wherever there is risk or wherever risk comes up as the red flag or there is something which is a canary in the coal mine sort of a situation. Last but not the least, immediately implement control. There's a root cause analysis which you need to do and you need to control it. I talked to you about optimal risk adjusted returns. This is a survey done by Morgan Stanley. This is a period from Jan 1980 to December 2021. Now, on one end, you see conventional ways of managing money, the predictable ways, the ways we are comfortable, from 100% bonds to 100% stocks and a balanced sort of fund in 50% bonds and 50% stocks. Well, what Morgan Stanley did is they added alternatives to this. So there is 1/3 private equity, 1/3 real estate, 1/6 equity hedge and 1/6 equity neutral to see what would be the impact on a quintessential portfolio like this. Turns out that it not just reduces the volatility across all portfolios, but increases the return. And these are documented facts, which are out there for anybody to verify. Seamless experience. When we talk about seamless experience, we are talking about how today's generation, today all of us. I was asking this question to somebody the other day. When was the last time you visited a bank? And I was asking a 40-year-old guy, and he says probably never. It's been ages since I've been to the bank. So people are now used to technology differentiating their lives in a big way. Why should it be very different when you're investing? So automated fact sheets, digital onboarding, digital reporting. You don't need to read through sheets of paper. You just get a digital reporting. Digital distribution. Today, you can actually access the nook and corner of the country without enhancing manpower. For somebody who's sitting in a tier 4 center in India, he has access to the same information. He can come on board through the same facilities and he can invest. So he can basically access the capital markets, and distributors can reach out to him. Marketing and communication. This is a very, very important thing. I think one of the key reasons why PMS Bazaar has succeeded and why this industry has succeeded per se is that there's a lot more information out there. The more the information is, the more the transparency is, the more the spotlight is, the less the opaqueness is, and the more the comfort is of the investor. Last but not the least is the emphasis on quality. And I am talking about quality as a factor, not quality in general terms. In the next few weeks, we will be releasing a white paper on quality as a factor in terms of investing in India. Turns out that, and this is something we analyze 5-year rolling returns on quality indices, whether it's the Nifty Mid-Cap Quality Index or the Nifty Quality Index or the Nifty 100 Quality Index. Turns out that your returns are far more consistent over longer periods of time, and more importantly, your drawdowns are far less sharper, which overall creates far more wealth for you as an investor. So focusing on quality really makes sense. So I talked to you about predictability, I talked to you about permanence of change, I also talked to you about good alternatives being around everywhere. Now let me just very quickly take you through Sundaram Alternates. We are a company which is growing pretty rapidly. We are one of the premier alternate investment funds in the country. We also have assets under portfolio management services. And this has been a growth. This is in terms of USD million. In Indian rupee terms, we are close to 7,000 crores at this point of time and growing rapidly. This is my core management team. I'm just doing my KYC here. This is me. My Director of Private Credit will also be in a panel discussion shortly, and Madan Gopal Ramu heads equity. Just to give you an idea of what the length and breadth of Sundaram Alternates spans, we do equity and performing credit across PMS and AIF platforms. In the PMS platform, in equity we have 9 unique strategies, 5 of them in PMS and 4 of them in AIF. Our total assets are over 3,500 crores. Our investment style is focused on quality as a factor. And more importantly, we have seen cycles. Our vintage is 12 years plus. That counts for quite a bit. Performing credit, again, coincidentally, we started off at the best possible time, which was probably the worst possible time in the Indian markets, 2018, post which we saw RERA, GST, COVID. And I'm very happy to report that our private credit funds, especially the real estate funds, have done extremely well. Touch wood, there has not been a single delay or default in any of our strategies so far, which counts for quite a bit when you're talking about the real estate debt fund. So we do 4 unique strategies, around 2,500 crores of assets. And of course, these are the portfolio yields, which are fairly attractive to NRIs as well. These are some of the awards which PMS Bazaar has given us. And we've also won an award for private credit. I'd just like to close by talking about the fact that change is permanent. You can't do anything about change. But always remember, if you go with a positive mindset, you will find there are good alternatives in life everywhere, especially in the AIF segment. Because if you worry too much, remember, you were worried about a lot of things yesterday about what is going to happen today. But today is the tomorrow you worried about yesterday. So why worry? When you have the mindset that there are good alternatives, just go explore. Thank you very much for your time.